Okay, great. So thanks a lot for having me, and I'm glad to be back at the Central Bank of Chile, even virtually. I think this is my third or fourth talk, usually in person, and hopefully next time in person. Um, this is joint work with David Zeke, who just moved to the Federal Reserve Board. And I should say, of course, these views are my own and David's, and not those of the Federal Reserve Bank of Chicago or the Federal Reserve System. Okay. So firm level microdata show really large differences in cyclicality or exposure to aggregate risk. And these patterns can have important implications for the allocation of capital and aggregate TFP. So in particular, when firms differ in their cyclicality, firm level capital investment is determined by a sort of standard asset pricing equation that relates the expected rate of return on capital. In this simple example, that's just the marginal product, to a firm-specific risk premium, which is given by the usual negative of the covariance of the return with the stochastic discount factor. In this paper, we're going to explore first the implications of this insight for macroeconomic dynamics, and second, for the effectiveness and optimal conduct of macroeconomic stabilization policies, and in particular, monetary policy. So before I tell you exactly what we do, let me just give you a flavor of the type of heterogeneity we have in mind. What I'm showing here is a really simple exercise where I've just taken the set of US publicly traded firms from CompuStat. And for each firm, I run a time series regression of its sales growth on aggregate GDP growth. And what I'm plotting in the left-hand panel is just the distribution of the coefficients from those regressions, what I'll call beta. Okay, and what we can see is these betas, so kind of the sensitivity of each firm's sales on aggregate GDP is extremely heterogeneous. It ranges from something like almost 10 to something like almost -5 with a mean of around 1, like we might expect. Okay. Now, for today's paper, the exact level of aggregation is not going to be super important, but what I've done on the right-hand panel, just to get a sense of where this heterogeneity is coming from, is kind of extract a full set of industry fixed effects and plotting just the within industry component of the dispersion in beta. And what we can see is more than half of the dispersion in beta is actually across firms within a particular industry. Okay. And by the way, feel free to interrupt with questions. I'm more than happy to answer questions as I go. Okay, so kind of guided by those patterns, we augment a standard New Keynesian business cycle model with two elements. First is going to be a cross-section of firms that differ in their cyclicality, exactly like in the picture I just showed you. And second is going to be a set of financial frictions that distort the kind of pricing of risk and the extent of risk taking at the micro level, and so is going to distort the allocation of capital. Okay. We show first that these features lead to rich implications for macrodynamics. And in particular, we uncover what we think is a novel, what I'll call like two-way feedback loop between macrodynamics on the one hand and the microallocation on the other hand. Okay, and just to give you a sense of how that's going to work, macrodynamics manifested through aggregate TFP is going to determine the extent of risk in the economy. The microallocation itself is going to depend on the amount of risk, but aggregate TFP is going to depend on the microallocation. And so you can see this loop. And what that implies is that all three objects, aggregate TFP, the amount of aggregate risk, and the microallocation are all endogenous objects that are jointly determined in equilibrium. Okay. We're then going to use this framework to study the positive implications for monetary policy. In other words, what are the effects of monetary policy in this type of heterogeneous firm environment, as well as the normative implications. In other words, what should monetary policy be doing?
Joel?
Yep.
Yep. Hi, here, Marco from the bank. I guess there are more ways through which firms could be heterogeneous in terms of their cyclicality, right? Like the story that you're telling us here is one, but I could imagine it could also be because they have different price rigidities in both, let's say, in their when they sell, and therefore that could also explain your first figure. And I don't know if you're going to discuss another potential channels of how this may happen, the differences in cyclicality.
Yeah, so no, it's a great question. So we're really going to take as basically given the differences in cyclicality and not really take a stand on exactly why. We have some stories in our heads. Definitely heterogeneous price rigidity is one, although within an industry, I'm not so sure how prevalent that is, but maybe you guys know a bit better than me. Other stories we have in mind is differences in quality. It turns out high quality goods, even within a sector, tend to be more pro-cyclical than low quality ones. So the story I have in mind is like, take the airline industry in the US. There's American Airlines. I don't know if we call that high quality, but it's high-ish quality. And there's Southwest Airlines, which is kind of a discount airline. Americans still fly home for Thanksgiving in a recession, but they trade down from American to Southwest. That makes American more pro-cyclical, and that makes Southwest less pro-cyclical or even acyclical. As another example, we looked at some data on publicly traded firms in the restaurant industry because we happen to have a proxy for quality there. And we saw something like Ruth's Chris Steakhouse, which is an extremely, pretty expensive steakhouse. They're extremely pro-cyclical, whereas McDonald's is almost acyclical. Okay, so you can think about some combination of all these stories, but we're kind of going to take that as given and exogenous for today, and just think about the implications for the allocation of capital, for macro dynamics, and for policy.
Perfect. Thank you.
Sure. Okay, good. Okay, so for today, I'm going to highlight three main results, and of course, we have others in the paper. First, we're going to investigate this new role for monetary policy. It's going to affect the extent of risk in the economy, the allocation of capital across firms, and the dynamics of TFP itself. I'll show you that optimal policy, well, at least given the distortions that we infer from the data, optimal policy is going to be more counter-cyclical in the presence of heterogeneity in order to account or alleviate really the distortions to the allocation. Okay, and what I mean in particular by more counter-cyclical is think about a standard notion of the output gap. So think about actual output relative to potential. When I say more counter-cyclical policy, I mean a counter-cyclical output gap. Okay? And what that means is that in good times, the central bank is going to want to set a negative output gap. In other words, driving actual output a bit below potential, and in bad and smoothing off the top of expansions. And in bad times, the central bank is going to want to set a positive output gap, keeping actual realized output above potential, so smoothing off the bottom of recessions. Okay, and that might sound like obvious, but for people who have worked in the new Keynesian literature, traditionally the policy prescription is to keep the output gap exactly zero. Okay, and I'll show you here, there's going to be incentives for the central bank to depart from that. Okay, in the third part of the paper, we perform a fairly simple quantitative exercise just to gauge the potential gains from optimal policy. And we show that there's significant gains from optimal policy here. But I think what's really striking is that the lion's share of those gains are going to come through correcting the allocation. In fact, those gains are going to be like an order of magnitude larger than the traditional welfare effects of like inflation volatility and output gap volatility. Okay, another way to think about the result is that there's significant welfare losses if the central bank ignores heterogeneity. In other words, if it operates like it's living in a representative firm world, but it's really living in a heterogeneous firm world.
Joe?
Yeah.
Sorry, here you're saying you're pushing basically the idea that there are some distortions within industry, distortions to the capital allocation that are due to financial frictions, for example. But do you provide any kind of like micro level evidence? I mean, like based on some sort of proxy for financial frictions, maybe some like share of external finance for the firm, and how that relates to the beta that you're showing us here. So basically, to build the case that this is more likely to happen rather than, for example, the explanation that Marco was saying before.
Yeah, so first, working your question backwards, I don't think that these two explanations are mutually exclusive. You could certainly say some of this heterogeneity is coming from heterogeneity in pricing frictions. That's perfectly fine for us, and that doesn't really affect whether there are financial frictions or not. So those could like kind of jointly coexist in the data, and they probably do. It turns out what we're going to have here is it's interesting. It's not going to be a firm-specific friction. It's going to be an aggregate friction, and the key is going to be that it has some cyclical properties. And I'll kind of take a reduced form approach, and I'll provide you a bunch of different micro foundations that you can keep in mind. And at the end of the paper, hopefully I'll have a little bit of time, I'll talk about how to calibrate those some of those micro-founded stories. Okay, and it's going to be things related to, I mean, the main story I'm going to show you today, but we have a bunch in the paper. I think I have two I'll talk about today. The main one I'm going to focus on is going to be like a constrained financial intermediation, kind of in the style of the Gertler-Karate models, if you know those. Okay, so think about these banks. These banks have to finance basically finance firms by holding their equity, but the banks themselves are facing some constraints. And I'm going to show you like a modified version of Gertler-Karate that fits neatly into my framework today.
I see. Thank you.
Sure. Yeah, it's kind of interesting and subtle, even though there's only, I just want to say one more thing about this and then I'll move on. Even though the frictions are going to be kind of aggregate frictions, because each firm has a different sensitivity on aggregate stuff, it turns out that it kind of turns into a firm-specific friction, kind of endogenously. Okay, and I'll show you that. Okay, good. So any other questions on the intro?
Like, if some of this heterogeneity or cyclicality sort of comes from a decision by the firm in sense of like the low quality, high quality example you gave, would that be affected by monetary policy? Like the choice of being high quality or low quality and the extent of cyclicality, would that be affected by monetary policy?
Yeah, no, that's a great question. You could think that it would. We're not going to have that today. This is something we've run into, and it's a slippery slope, is like you always are tempted to endogenize the next thing. So for today, we're going to limit ourselves to say, given that we see these differences in the data and taking them as fixed, what should monetary policy be doing? And what does monetary policy do? I think we've endogenized a lot of stuff, and definitely a next step in the agenda could be to endogenize those and understand how they might interact with policy. I don't know if like at a cyclical, what you have to have in mind there is like at a firm cyclicality itself is changing at a cyclical frequency. And I don't know how prevalent that is or not, but that's something we could think about and could definitely be a next step, but I don't have that for you guys today. Okay, so let me just give you a brief plan of what I'm going to do. So the presentation is really going to be divided into three parts. I'm first going to introduce just a really simplified, like the simplest thing we could possibly think of, a simplified, frictionless real model. And I'm going to kind of investigate that model in some detail and really use it to illustrate the link between risk, microallocations, and macrodynamics. And you might be sitting there like, if this is like all about monetary policy and financial frictions, why this frictionless real model? I promise you, if you bear with me and understand the economics of the simple model, everything else is going to follow like immediately. Okay. In the second part of the talk, I'm going to embed that simple model into a new Keynesian framework with what we said financial frictions, study the conduct of monetary policy, and then we'll go through the quantitative exercise. Okay, so jumping right into the model, again, this is just my simple example. So I want to think about a representative household. Household has CRA preferences over consumption. Risk aversion is gamma, and because I'm studying risk throughout the paper, we're going to assume gamma is bigger than 1. And the time discount rate rho. The stochastic discount factor is completely standard. I call it capital lambda, depends on the time discount factor, and consumption growth to the minus gamma. The household holds a stock of capital. There's no labor for now, but I will add labor later for the new Keynesian elements. Okay. And a kind of an important simplifying assumption that I'm going to keep throughout the paper, I'm going to assume that the aggregate capital stock is fixed. Okay, so what that means is that consumption is going to equal output. So a very simple aggregate resource constraint. This is a really standard assumption in new Keynesian models. And what it's going to do here is mean that the only interesting decision going on in this economy is how to allocate this kind of fixed pie of capital across all the heterogeneous firms. That's the only decision that's going to happen. Okay, so like I mentioned, firms are heterogeneous. They produce using kind of a standard production function, only capital for now, with some curvature alpha. Again, I'm going to add labor. And importantly, and really crucially, firms are heterogeneous over productivity, what I'll call AIT. Okay, and more specifically, using lowercase letters to denote natural logs, which is going to be true throughout the talk, excuse me. The log of a firm's productivity, little AIT, is going to depend on an aggregate shock, what I'll call AT. But each firm is going to have a different sensitivity or loading on the aggregate shock, which is given by these betas in blue. Can you guys see my cursor if I do that? Yeah, okay, good. So intuitively, what's going on here? Well, imagine a firm with a really high beta. That firm is going to be disproportionately pro-cyclical. When aggregate conditions are good, meaning a high realization of little AT, that firm's productivity is going to jump a lot. You could have a firm with a zero beta. That firm is acyclical. You could have a firms with negative beta, and those firms move countercyclically. Okay, and this is really the only extension we're doing right now over like a standard basic business cycle model with capital. Okay. This term fancy O is just a bunch of Jensen's inequality corrections. We don't have to worry about that. It's independent of everything else in the model. For right now, I'm going to assume that the aggregate shock AT is IID over time with some variance sigma squared epsilon. And I'm going to assume that these betas are normally distributed, and that's in the cross section of firms with a mean of 1 and a variance of sigma squared beta. Okay. And by the way, I haven't just highlighted random things in blue. I've highlighted things that I think are new, things I think are important, or things I think are kind of new and important. Okay. Like I said, the AT shock right now is IID. Later, when I get to the quantitative work, I'll add persistence. That's not going to change much, and I can explain why when we get there if you guys are interested. Any questions about the firms? Okay, and again, the key kind of crucial element here is this dispersion in betas. And again, in the cross section, it's distributed with variance sigma squared beta. Okay.
Yeah, Joel, I have a question because here this kind of the variation in cyclicality given by the dispersion of these betas, you're building it in. It doesn't come from another friction, let's say, in the capital market for now.
No, it's not. It's going to be independent of capital market frictions. We're just assuming this is like an innate characteristic of the firm. Again, there are some caveats when we do that, which you guys have pointed out, which is A, it's not responsive to monetary policy. I think that's like the key caveat for the counterfactuals we're going to do. You could imagine, I would have in mind a story where because of some other financial constraints, the firms have different cyclicality. Those financial constraints are affected by monetary policy. I'm not going to have that about these betas. We're just taking them as given for today, and we're going to tease out the implications of having these differences. But again, the next step would be, endogenize the betas, understand how they interact with other frictions or with policy.
I see. Thank you.
Right now I'm sticking also, by the way, to a frictionless model. No distortions are going to be in this model. I'll talk about that. And then like in 4 slides, I'll talk all about capital market distortions, and you'll see exactly how we're going to include them. Sorry, I'm like flicking through things. Great. So the firm's investment choice is completely standard. The firm chooses capital at the end of period T-1 for use in production in period T to maximize expected discounted profits, where importantly, the firm uses the household's discount factor to discount cash flows. Okay, and the optimality condition just says that the expected discounted marginal product of capital is set equal to the rental rate. And in this right-hand equation, I'm just showing you the definition of the marginal product of capital here. Okay, so nothing new there. If I take a second order approximation to that expression, I get exactly the equation that I showed you in the introductory slide. And that's where that equation is coming from. It says at the firm level, the expected marginal product of capital equals a constant, which is basically the risk-free cost of capital, plus a firm-specific risk premium, which is the negative of the covariance of the marginal product with the log of the stochastic discount factor, which I'm calling little lambda. Okay. So to get the intuition, think about like a high beta firm. We already talked about a high beta firm is disproportionately pro-cyclical. It's going to have a high marginal product in good times. Good times are times when marginal utility is low. The stochastic discount factor is low. So a high beta firm is going to have a significantly negative covariance between its marginal product and the discount factor, and so a positive risk premium. Okay, a firm with a zero beta, its marginal product of capital is not going to be correlated with the discount factor at all. So it pays the basically the risk-free cost of capital, whatever is inside the constant. Okay, and then you can think about a negative beta firm. Its marginal product is going to be countercyclical. It pays off in bad times. It's a good hedge. It's going to have a negative risk premium. Okay. So riskier high beta firms higher expected marginal product of capital. And because of diminishing returns to capital in the production function, that means those firms are going to have less capital. They're going to be smaller. I mean, one thing I thought was kind of interesting about that is there's a lot of kind of stylized facts in the finance literature about the size premiums. Small firms see higher average returns than big firms. In this model, the causality is kind of in the opposite direction. It's like high return firms have to be smaller because of diminishing returns in the production function. Okay. Is it clear? Good. Okay, so kind of in a first result, we can show that despite all this heterogeneity, from an aggregate point of view, this economy is observationally equivalent to a representative firm economy, except where aggregate TFP is endogenous. Okay, so what I'm showing you in the left-hand equation is just the definition of aggregate TFP. It's like the solo residual in an aggregate, in a reduced form aggregate production function. KT is the aggregate capital stock. In the second equation, what we're showing is that aggregate TFP is equal to a weighted average of all the firm level TFPs weighted by their shares of the capital stock. Okay. And in the third equation, I'm showing what determines firm level shares of the capital stock is basically something like the expected discounted productivity of a firm relative to some appropriate average of expected discounted productivity across all the firms. And just to be clear, the first two equations here don't really have any economics in them. They're just accounting. I just kind of rearranged the production functions. All the new economics kind of comes in the last equation. What determines firm shares of the capital stock? Okay, again, I kind of mentioned the interesting decision here is how am I allocating capital across firms? Okay, now if you stare at these equations for a minute, you can maybe start to see this like two-way feedback loop between macro and micro I mentioned in the intro. If you look at the middle equation, TFP clearly depends on the allocation of capital, okay, because it's basically a weighted average of all the firm level TFPs weighted by their share of capital. But if you look at the right-hand equation, the allocation of capital depends on the discount factor, which is going to depend on TFP. Okay, so those two things have to be solved jointly because they both depend on each other. Okay, now in the paper, we derive like an exact closed form solution for TFP, but it turns out I can get really sharp expressions using a second order approximation. So that's what I'm going to show you guys for today. And in particular, we can show that the log of aggregate TFP, what I'll call this little psi t, is an affine function of the aggregate shock AT with an endogenous constant, or what I'll call a level term, psi bar, and an endogenous loading on the exogenous shock, what I'll call psi A. Okay, and both of these terms, psi bar and psi A, depend on particular moments of the capital allocation. Okay, so looking first at this level term psi bar, it depends on the variance of the marginal product across firms. For anybody who's worked in the firm dynamics or misallocation literature, that shouldn't be super surprising. In log normal environments or up to second order, the losses from misallocated resources are always a function of the variance of the marginal products. And that's what's happening in the level term psi bar. What's kind of more novel here is the endogenous exposure to shocks of the economy, psi A, and that depends on the covariance of capital and beta across firms. Okay, so what's the intuition here? Imagine that high beta firms get a lot of the capital stock, so they're really big. They're the pro-cyclical firms. The whole economy naturally becomes more pro-cyclical. Okay, if low beta firms have a lot of capital, they're less cyclical. The whole economy is naturally going to become less cyclical. Okay, so the two key moments here again are the variance of the marginal products that determines the level of TFP, and the covariance of capital with firm cyclicality that determines the exposure of endogenous TFP on the exogenous shock AT. And notice here, by the way, that I fed in like an aggregate technology shock AT, but when I measure TFP, like a solo residual approach, I'm not measuring the exogenous shock, I'm measuring something endogenous that depends on the allocation. Okay. So once I have this nice form for TFP, I can solve for the dynamics of the discount factor. So I'm looking here at the unexpected shock to the log of the discount factor. Because everything is IID, that's just equal to minus risk aversion times output. Remember, output is consumption. Okay. from the top equation on the left, the only reason output is moving around here is because TFP is moving around. Remember, the capital stock is exogenous and fixed. So there's no movements and factors of production in the aggregate. Only TFP is moving around. And so the log of aggregate output is just psi A, this loading of TFP on shocks multiplied by the shock itself. Okay, and from there, I know this is like a lot of math in one line. Hopefully it's not super unclear. And from there, I'm going to define a new object, what I'll call kappa. Kappa is going to be super important. It's going to show up throughout the talk. It's going to be like a risk adjustment that's going to affect the allocation. Here, it's basically the elasticity of the discount factor to exogenous shocks, and it depends on risk aversion gamma and the sensitivity of endogenous TFP to the exogenous shock, which is captured by this term psi A. Okay. So if you didn't follow all of that, all you need to remember is this very last term, kappa, depends on risk aversion, and psi A. Okay. Good. So that's TFP. Now moving to the microallocation, I can get a nice expression for firm level capital choice, again in logs. So firm capital depends on its expected productivity. That always shows up in this kind of model, but here we also have the risk premium showing up. Here I just express it as the covariance of firm productivity with the discount factor, and we can hopefully see that the allocation is going to depend on the discount factor and specifically the risk adjustment kappa. Okay, kappa is going to determine the dynamics of the discount factor. That's going to determine in part the microallocation. And we can see that very clearly, I hope, this fixed point where by definition, kappa or the risk adjustment depends on the microallocation through psi A, but in reverse, the microallocation through psi A depends on kappa. Oh, and I have a neat picture for you guys. This is something new, I forgot. All right, so just to kind of make it really clear, what I'm showing in the top graph here is firm capital choice graphed against firm beta. The horizontal line is a world with no aggregate risk. So when the risk adjustment kappa is 0, so that you could either think about that as being risk neutral agents or no aggregate shocks. In that case, the firm capital choice is purely determined by productivity or expected productivity and is independent of beta. And that's why the line is flat. Whereas with aggregate risk, or when agents are risk averse, what we can see is high beta firms choose lower levels of capital, low beta firms choose higher levels of capital. Okay, moving to the second picture, I'm showing the distribution of capital across firms. In the world with no aggregate risk, when kappa is 0, again, capital choice, it's independent of beta, and the distribution with respect to beta just follows the distribution of betas. Okay, with aggregate risk, the whole distribution is shifted a bit to the left because low beta firms get more capital. Okay, hopefully that makes things clear. Yeah. Okay, good. So starting with the microallocation, what I've done on the left-hand equation is solve out for this conditional covariance. So remember, sorry, I have to flip back. I had expected marginal product of capital as a constant plus a risk premium, which is the negative of this covariance term. Given that I know now the dynamics of the discount factor determined by kappa, I know what the marginal product looks like. I can solve out for that covariance. And here I'm showing it's the product of 3 terms. The first is the firm's beta. So high beta firms are riskier. They have a higher risk premium and a higher expected marginal product of capital. The second is the variance of aggregate shocks. You can think about that like a measure of the quantity of risk in a particular sense. And the third is the risk adjustment kappa. Okay, and the product of those 3 terms is the risk premium in this model. Turning to the right-hand equation, exactly the same risk premium enters the firm capital choice. High beta risky firms choose lower levels of capital. Okay, and given that expression, I can easily see the key effects of macrodynamics and really of risk on the microallocation. So think about a comparative static where I increase kappa. There's going to be 2 effects. First, when the amount of risk goes up, kappa goes up, it discourages risk taking at the micro level. Firms see a lot of risk in the world, and they themselves take on less risk. That's going to reduce the covariance of capital with beta. In other words, my risky high beta firms are going to choose less capital. Okay, and so that covariance is going to be lower. Okay, we can see that covariance, by the way, is negative. but it's going to become more negative if I increase kappa. Okay. I'll call that like a risk-taking effect. The second effect is going to be when there's more risk in the world, we're going to get bigger spreads in firm expected returns, and that's going to increase the variance of the marginal product of capital. Okay, that depends on kappa squared. So when kappa gets bigger, the variance of the marginal product of capital is going to go up. And that's really because investors or the holders of firms are requiring higher rates of return for riskier firms and lower rates of return for safer firms, and those spreads go up when there's more risk. Good. So with those expressions, I can turn back to the macro side. Remember, aggregate TFP is psi bar, which is one endogenous constant, plus psi A times AT, where psi A is this endogenous loading on aggregate on the exogenous shock. Okay. What I'm showing here is first the level effect. That's psi bar as a function of kappa. What we can see is that this term is always negative, and it means that with more risk, I showed you in the last slide, I get more dispersion in marginal products of capital, the level of TFP is going to fall. Okay. What I'm showing in the right-hand term is the effect on psi A. I'll call that a volatility effect. And what it shows is when there's more risk, when kappa is higher, agents take on less risk. They shift capital to less cyclical firms, and that reduces psi A, or reduces the sensitivity of the economy to aggregate shocks. Okay, what's kind of interesting here is I call it like a volatility verse level thing. When risk goes up, let's do the reverse. When risk goes down, psi bar, the level of TFP goes up. We kind of think that's probably good, but the volatility or cyclicality of TFP also goes up. So this economy is facing some trade-off between the level of productivity and the volatility of the economy. We can solve out for the equilibrium risk adjustment, kappa.
John?
Yes.
Very quick, just for clarification. So far, everything is efficient, right?
I'm going to get to that. Yes, you're correct.
Okay, thank you.
I'm going to talk. That's my last bullet. You might be able to see it in light gray or something. So I'll come back to that in a second. Okay, so here we solve out for the equilibrium risk adjustment kappa. It's really intuitive. It's got a partial equilibrium term and a general equilibrium term. The partial equilibrium term is the numerator gamma. So if I was living in a partial equilibrium world, the risk adjustment is just risk aversion, gamma. Okay, because of my general equilibrium world with heterogeneous firms, gamma also pops into the denominator and depends on the extent of heterogeneity across firms, sigma squared beta. And that's because as I'm increasing risk aversion or increasing the amount of risk, the economy endogenously reacts by shifting capital to less cyclical firms, offsetting some of that risk. Okay. Good. So just to sum that up, and I'll also talk about the efficiency question that just came up. What are the key effects of risk and reallocation opportunities on macro dynamics? It smooths TFP. Psi A, the exposure of the economy to shocks is less than 1. In a representative firm economy, it would just be exactly 1. Sigma squared beta would be 0. So you can see that from the expression. It's going to depress the level of TFP. Psi bar is negative, whereas in a representative world, psi bar would just be 0. We saw this trade-off between volatility and level, but as the question pointed out, in this version of the economy, that trade-off is efficient. There's no role for policy here. So this economy is going to experience marginal product dispersion. We're going to see macroeconomic volatility. All of those are just symptoms of the efficient allocation.
Joe?
Yes.
Yeah, I have a question here. So, I mean, the volatility effect, it's also a result of the fact that sigma beta is constant, right? This is assumed to be exogenous. It's something you were saying at the beginning. You don't rationalize why we have the betas that we have. It's just what it is. But it could be the case though that the increase in kappa, actually the decrease in kappa, also lowers sigma beta, no? And that would be a different. I don't know if there would be a trade-off in that case. Yeah.
I mean, you might be able to come up with some knife edge assumption that kind of makes that hang together. One thing I'll say in response is, measuring betas is hard, and I'm going to come back to that actually. There are a lot of papers in finance that look at like high frequency variation in like stock market betas, like CAPM betas and things like this, and they don't find a ton. And we have a paper in the JFE, a predecessor of this with a similar mechanism. It's about a slightly different focus, and there we kind of looked into that. And there's a lot of persistence in betas at the firm level. We tried to do like rolling estimating betas using like some high frequency rolling windows and things like this. So I think in the data, I don't think we're going to see enough variation over time in sigma squared beta to offset what I'm showing you here. That doesn't mean there isn't some, so I'm sympathetic with that. Probably in a model, you could come up with the right condition that makes that hold, but I'm not sure that really would be borne out in the data.
Oh, thank you.
May I ask you a broad question? I should ask at the beginning. What do you think about this Bloom-Gubenen stuff that talks about asymmetry, skewness shocks?
Yeah, no, I mean, we could do like, imagine we could do something like that here too. And I think it would strengthen the effects. I think that's an interesting question. I mean, imagine, for example, this kind of economy, but with disaster risk. Then you would get bigger risk premium. If firms, in really bad times, if firms react differently to that, that would show up in firm level risk premia. And I think that would be like an interesting way to go and would probably amplify the effects. There is one thing I want to say, which I was going to point out later, but I can say it now. To the extent you want to think about other models that generate risk, if they show up like in something close to just increasing risk aversion, in the end, our results are not going to be super sensitive to that. And that's because of this expression for kappa. If you get a piece of paper and you do a little bit of algebra, if I increase gamma here to like infinity, kappa does not explode, it asymptotes. And that's because of the general equilibrium effect of gamma in the denominator kind of balancing with the partial equilibrium effect in the numerator. So it's like, as I just send risk to infinity, these agents just reallocate towards low beta riskless firms. And eventually the economy just reaches asymptotes to a interior level of kappa. So I cannot just blow up the amount of risk however much I want in this economy. And what's really interesting about that, or one thing that's interesting about that, it's got a relation to just a standard model, representative firm, like a production-based asset pricing model, where if you increase risk aversion a lot, agents just undo it by saving, okay, and smoothing consumption more and more. Here, I don't have aggregate savings, but agents smooth consumption through reallocation in the cross-section. So it's like a similar idea, but a different mechanism. Yeah. Okay. Okay, good. So coming back to the question, right, the trade-off here is efficient. There's no role for policy. So what I'm going to do next is give a role for policy and give a tool for policy by embedding this kind of setup into a new Keynesian model with the financial frictions. Okay, so a role for policy is going to come from financial frictions, and a tool for policy is going to be monetary policy. Okay, so here we're going to have, a continuum of households. Now they have CRA consumption preferences, over consumption and leisure. Okay, so very standard utility function. There's going to be wage setting friction. So this is going to be quadratic adjustment costs of changing wages. That's going to lead to a labor supply condition where the real wage equals the marginal rate of substitution between consumption and leisure, but is distorted by this blue fancy MT, which is basically a markup of the wage over the marginal rate of substitution. Okay, and this is a standard New Keynesian setup with sticky wages. Okay. The final good is going to be produced by a competitive firm. It's going to bundle all these different varieties using a standard like CES aggregator. All the action is going to come with these intermediate good firms. Again, they're going to be heterogeneous over productivity, and now they produce using a standard Cobb-Douglas production function and capital and labor. Okay, so now it just looks a lot like a plain vanilla New Keynesian model. Okay, labor is chosen statically, period by period, after shocks are realized. So all firms equate the marginal product of labor to the wage. Optimal investment is almost what I showed you before. Firms equate the expected discounted marginal product of capital to the rental rate, except in the second kind of extension over the standard model, I'm going to assume that firms use a distorted version of the household's discount factor to discount cash flows. Okay, so this T lambda T thing in blue is a distortion. It's going to come from capital market frictions. Here is going to distort the allocation, but it's going to have no other effects. So if there was a representative firm, this distortion would do nothing. Okay, it's only going to have effects on the allocation. Okay, and what I'm showing in this final expression here is in logs. I'll call that little tau lambda T. The distortion is a constant elasticity function of the aggregate shock with a negative sign. So the sign convention here says with positive, imagine this parameter tau lambda A is positive. So this guy in blue with a positive realization of the aggregate shock. So in good times, the distortion is low. Okay. And with negative realizations of the aggregate shock, so in bad times, the distortion is high. I'm going to call that a countercyclical distortion. Okay, and that's the case when tau lambda A is blue. And just to give the intuition, don't forget the household discount factor itself is countercyclical, right? It's high in bad times and it's low in good times. And so if tau lambda A is positive, which is going to be the case we find in the data, and I'll talk a bit about that, it's really just augmenting movements in the discount factor. The discount factor is naturally countercyclical. There's some distortions from capital market frictions that are making it even more and inefficiently so countercyclical. That's going to make agents act like inefficiently risk averse because the price of risk is too high. They're seeing too much risk in the world coming from financial frictions. Questions about that? I had a lot of questions about the frictions before, so I'm happy to answer questions here. I'm going to give some micro foundations on the next slide. Maybe I should show those first. Okay, so let me give you some micro foundations. So what I'm going to argue, and I'm going to convince you, is that this formulation of the friction can capture like a whole host of distortions you might think about. Okay, so like I mentioned in response to one of the questions, the one we're really going to focus on is frictional financial intermediation, so banks. Kind of in the style of Gertler-Karate, but we modified their framework a little bit. We could just literally plug and play with their model. We've done that too, but we have kind of a version that fits nicely into our framework and is fully analytic. Okay, so I'm not going to give you all the details for now. Just think about a bunch of banks or financial intermediaries. They finance firms by holding equity shares in firms, so basically stock, and they face a convex, and we're going to assume quadratic cost of dividend payouts or equity payouts with a parameter theta. Capturing the extent of these adjustment costs on equity payouts. Okay. You know, when you work through all the details, I might show you some later, the details are in the paper. When you work through it, you get exactly the Euler equation for firm investment I showed you before, where this wedge depends on the shadow value of intermediary cash flows. How much does the bank value one more unit of cash flows? That depends on the negative of the adjustment cost parameter and the dynamics of the cash flows themselves. Okay. So when cash flows are high, the value of those cash flows is low to the intermediary. And that shows up in how the intermediary and the firm itself is pricing the firm's cash flows in the future. Okay? And you can see that this distortion is likely to be countercyclical as long as we're willing to believe, and this will be true in the model when I do the whole thing in general equilibrium, that financial sector cash flows are procyclical. Is it clear? I'm happy to click the details slide. I have the full model there if anybody wants to see it. It's not crucial for now. I just want you to have in mind that if I put some constraints in the financial sector, what's going to pop out is almost exactly what I showed you in this T lambda T, and it's likely to be countercyclical, and that's because it depends on the marginal value of cash flows. And for anybody who knows really well the Gertler-Karate literal model, this is like kind of a modified version of that, where the wedge in their exact model would depend on the shadow value of intermediary net worth. Also going to be countercyclical.
Joy?
Yes.
I am confused about one thing. So you just show us that firms that are most exposed to risk tend to be smaller, and that's sufficient. Another dimension is whether capital is going to get reallocated when shocks hit. So these frictions are going to distort the distribution of sizes, the steady state distribution of size of firms, and the reallocation across shocks, or?
Yeah, that's a good question. So actually in this model, because capital is chosen before the shocks are realized and the world is IID for the moment, there's actually never any reallocation of capital in this model. The firms choose the same thing every single period. Okay, but this distortion is going to distort what they're choosing, right?
Can you provide some intuition for that? Then we need to focus about the steady state distribution of capital of the sizes of the firms.
No, it's not this. It's not necessary. I'm not imposing a steady state assumption here. I'm saying that each period the firms get to make a choice. But shocks were realized yesterday. You know, some firms were disappointed because they're like, "Oh man, I chose a lot of. I thought my productivity was going to be high, and it turned out it wasn't." But everything is this. All expectations are the same here, period after period, and so they're endogenously just choosing the same thing. But that's a little bit artificial because that's just coming from my simplifying assumption of IID shocks. When I add persistent shocks later, the allocation will change over time with respect to expected productivity. But because the price of risk in this particular model is constant, the risk premium are not changing over time. Something we're thinking about is allowing for time varying risk. To do that, you need something like the volatility of shocks is changing, risk aversion is changing for some reason, something that would put a subscript T on kappa.
I'm happy with this simple model, and actually the IID assumption I think is great for intuition. I just want to have a story with pears and apples about how the financial friction is distorting what.
I'll show you. I think I have that on the next slide. Just give me two slides.
Awesome.
Give me 2 slides and I'll show you. Basically, it's going to show up inside kappa. Kappa is going to be too high. And then it's going to have all the effects I showed you in the simple model of reducing risk taking, increasing marginal product dispersion, but it's too high and it's inefficiently high. And there's going to be a role for the central bank to stabilize the economy to try and reduce kappa. That's going to be that's the name of the game. And that's where I'm going.
Okay, thanks.
And I'll show you that actually. Yeah. Here's a second example for anybody who works in the heterogeneous firm New Keynesian literature. Think about a model of limited asset participation. This is like a tank model, if people know that literature. So I have a fraction theta of households who are constrained. They hold no capital. Only a fraction 1 minus theta of capital of households, own the capital. Okay. And firms face markup shocks. This is a common markup shock that's redistributing firm revenue across profits and labor. Just with that model, nothing else. You get exactly the Euler equation again that I showed you, but now the distortion depends on the share of constrained households theta and depends on the dynamics of the markup. Okay, and so what's happening here is like only a subset of households hold capital. They're the ones pricing the asset. Because of the markup shocks, their consumption is more pro-cyclical than aggregate consumption, and that's making the world look riskier. Okay. We have a lot of other micro foundations in the paper, cyclical profit taxes, models of externalities and preferences, like keeping up with the Joneses, even some behavioral biases. I'm not going to go through all of those, but what I want to convince you is that this formulation of the distortion can capture a lot of these, okay? And a lot of kind of workhorse models of financial frictions that we know from the literature. Good. So given TFP, aggregate economy is characterized by these 3 equations. So the first equation just shows aggregate output depends on TFP. That's the first term, okay? And an output gap, the standard output gap in the New Keynesian model, what I'll call mu T. Okay? If you want, you could think about the first term here as being the natural rate of output, and the second term as being the output gap. That distinction is not going to be quite true in this model, and I'll explain that, but you can think about it that way for now if you want. Okay, but just think about aggregate output as being determined by TFP and the output gap, standard New Keynesian Phillips curve, standard IS or consumption Euler equation. And I won't go through those in detail. Okay, so last I have to take a stand on the conduct of monetary policy. For now, I'm going to assume that monetary policy, and this actually proves pretty convenient, monetary policy is going to directly choose the behavior of the output gap. So it's going to choose a parameter mu A that's going to tell me what the output gap is as a function of the exogenous shock AT. Okay, I'll call monetary policy countercyclical when mu A is negative. So in response to a positive shock, the central bank is going to set a negative output gap, meaning it's going to push actual output below potential, and with bad times, a negative AT shock, it's going to set a positive output gap. It's going to keep actual output above potential, and that's going to be stabilizing the real side of the economy.
That's a little bit odd. Shouldn't be monetary policy affecting the wage inflation, or at least a combination of them?
Monetary policy is going to affect everything. I'm just saying monetary policy is just going to choose an output gap, and then we're going to run that through the model to see how it affects everything else. A more standard approach.
So this is the rule. This is the
rule
form of the rule. Okay, got it.
Yeah. Exactly. And it's going to be the rule that's key in this model. You're going to see that. Right. So monetary, that's a great way to put it, and I'll talk about that later. Monetary policy chooses a rule in output gap space. If you're more comfortable with interest rate rules like Taylor rules, we can show that any Taylor rule you pick just would determine a particular value of mu A. Okay. So if I picked an interest rate rule, it's more complicated because I would use the IS equation to figure out output, then the output gap from the output equation, and then mu T from the inflation equation. Here I'm saying is just directly tell me mu T, and all I would have to do to figure out the nominal interest rate that supports that is use the IS equation at the end. Okay. And just to make that more clear, my assumption of this output gap rule implies a nominal interest rate that satisfies this equation. It says the nominal interest rate equals the natural rate of interest, what I'll call R star, minus a term that depends on mu A. So you can say with a more negative mu A, a counter-cyclical output gap, that means a more pro-cyclical nominal interest rate. And in fact, when I think about the behavior of policy in my quantitative work, my gauge of the cyclicality of monetary policy is going to be the cyclicality of the nominal interest rate. Okay, so again, just to kind of go through those bullets, I know that maybe was confusing. Any rule I pick for mu A can be supported by an interest rate rule. Okay, any interest rate rule I pick would just imply a particular value for mu A. It just turns out for solving the model, it's kind of more convenient for us to let the central bank choose mu A, because it means I can kind of discard the IS equation. That would just be used to pin down the nominal interest rate. Okay.
A very quick reaction to that. I'm not sure you want to go there, to that discussion about the interest rate. Because my understanding is that that's the interest rate that is consistent with the mu reduced form policy on the equilibrium path. But you don't want to get into the discussion about determinacy and blah, blah,
exactly.
blah, which
Completely.
had nothing to do with the point.
I completely agree. Our approach completely disregards that. All right.
Yes.
This point about the nominal interest rate, of course, has the usual caveats of how interest rate rules affect determinacy and things like this. Completely agree. Okay. No question. And we don't talk about that too much in the paper. It's just that we wanted to show this mapping, and we show it like in the appendix of the paper, just because it's more typical to think about interest rate rules. But we want to make clear, like, our approach could be supported by an interest rate rule. And that's kind of the point. Okay, but I completely agree. And thanks for the suggestion.
That's the thing. That's not a rule. That's relationship.
Yeah, exactly. Let me be more clear.
And you don't want to have a discussion about rules. Yes.
Yes, I agree. Okay, so coming back to the question from before, what are the effect of these distortions and stuff? Why did I show you the whole simple model in the first place? It turns out in this fully fledged New Keynesian model with distortions, TFP takes exactly the same form as what I showed you before. Psi bar and psi A take exactly the same forms that I showed you before as a function of kappa. Higher kappa, more risk, means lower level of TFP, psi bar, lower volatility of TFP, psi A. The only difference here is in the definition of kappa. Okay, kappa now, before kappa depended on like gamma and psi A. Now it also depends on psi A, but with a more complicated term that I'm not going to show you, kappa psi. It depends directly on the distortion, and it depends on the behavior of the output gap. So these are the three sources of aggregate risk in the economy: fluctuations in TFP, fluctuations in this capital distortion or wedge, and fluctuations in the output gap that are chosen by the central bank. Okay. If the distortions are more pro-cyclical, it's like the agents perceive more risk in the world. The risk adjustment is too high. If the central banks is setting an output gap that's not counter-cyclical enough or is like too pro-cyclical, that's also going to lead to more risk because it means the whole business cycle is more volatile. So the only difference between, in terms of the allocations and all the new mechanisms in the model, between the full-fledged New Keynesian version and the baby model I showed you is coming through the definition of kappa. There, kappa only depended on TFP and was very simple. Here, kappa depends on TFP, financial frictions, and the behavior of the central bank. Okay, and maybe you guys, one more thing I want to say, and I'll take the question. Maybe you guys have heard about this idea of the Fed put. So there's a literature in finance that says, you know, the Federal Reserve tends to prop up asset prices because the stock market participants know if times are too good, the central bank is going to step in and kind of, you know, take away the punch bowl, so to speak. And if times get really bad, the central bank is going to step in and try and shave off the bottom of recessions. That reduces the amount of risk in financial markets, and that keeps asset prices high. That same logic is what's going on here, but kind of applied to real allocations. Sorry, I'll take the question now.
Thank you. So I'm just thinking, like, as you mentioned, so the central bank affects kappa through the effect of monetary policy over the output gap, right? But I was thinking, like, in a framework with financial frictions, which I guess is represented by the capital wedge.
Yep.
Shouldn't that also react to monetary policy, like a collateral constraint or something like that? No.
Absolutely. So I'm going to, hopefully I have a bit of time. By the way, I started a bit late, so what time do I have to end?
Until you have half an hour.
I have half an hour. Okay. So let me go back. That's a great question. I'm going to talk about that at the end. I have a whole slide on that. Even going back to my two micro foundations, if you look at micro foundation 1, this is going to be endogenous to policy because monetary policy is affecting everything, including the cash flows of financial intermediaries, excuse me. Okay. If you look at this version, this one is exogenous to monetary policy. Nothing here depends on monetary policy. Okay. I'm going to allow the distortion to be endogenous later. From now, I'm going to keep it as exogenous, and I'm going to show if anything, the effects are going to be bigger. Okay. And the reason why, and they're going to go in the same direction and just amplify everything I'm going to show you. And the reason why is here, I'm about to talk about this, so this is a good place. If the central bank is doing counter-cyclical policy, so reducing mu A, here this is going to directly reduce kappa, right? In the model with endogenous frictions, it's going to also reduce the wedge at the same time. Okay, and the effects are just going to be bigger. Okay, there's going to be cases where the effects could go the other direction. I'll talk a bit about that. It's really hard to come up with a story where that's going to be the case, and we couldn't come up with a good story, but we tried hard. And I'm definitely open to hearing your guys' creativity on stories where it goes the other direction. And the key kind of condition for endogenous distortions to make things bigger is that if the central bank is doing more stabilizing, the distortion itself should become less volatile. That sounds intuitive to us. I'll prove to you that's going to be the case in this model of frictional financial intermediation. We tried to come up with some stories where the central bank stabilizes and distortions become worse or more volatile. We couldn't really come up with anything plausible, but again, I'm happy to hear if you guys want to brainstorm about that after. Okay, so long story short for now, let's take the distortion as exogenous. Hopefully I'll have time to talk on the last two slides about the endogenous distortions. Okay? But something we thought a lot about.
Another angle is that given that, I mean, you're trying to make the point that this is an example of a distortion, but you can come up with others as soon as they have the right cyclicality, it's going to be okay. But sticking on this one, this is testable. I mean, you can go to more volatile firms with get some measure of financial frictions and see whether the correlation is the one that is assumed in the paper.
No, we have to be careful because this distortion is common across all the firms. So you wouldn't see any heterogeneity in this guy at the firm level. Okay, it's going to distort the allocation through the Euler equation. So something endogenous. So I'm not imposing an exogenous heterogeneous distortion, right? There's no I subscript on this guy. Basically, all right, let me try and make this clear because this is important. Let's go back to my simple model. Look at the expression for capital. This expression holds in the full-blown model as well. It's just that the definition of kappa now has the distortion in it. And the reason why it's affecting firms in heterogeneous ways is because of this beta, which I imposed on productivity, but is now showing up everywhere. And that's, I think I mentioned that kind of in the introduction in response to a question, that once you allow these firms to be heterogeneous to one aspect of aggregate conditions, it tends to flow through to all different aggregate conditions, all different state prices, aggregate distortions, etc. So hopefully this makes things clear, actually, that the reason monetary policy and distortions matter here, it's coming through the kappa. This expression will still hold. It's just that the definition of kappa is different, and kappa could be inefficiently high or low, and that's going to distort the allocation of capital relative to the first best. Okay, that's also causing dispersion in marginal products of capital, which could be inefficiently high or low, depending on whether kappa is too high or too low, again, relative to the efficient economy. Okay, so moving right along. Okay, so from here, we kind of talked about this. How does monetary policy affect the dynamics of TFP? I think it's kind of clear. More counter-cyclical policy, lower mu A, reduces the amount of risk. It reduces the risk adjustment kappa. That's going to increase the level of TFP. It's also going to increase the volatility of TFP. So counter-cyclical policy induces risk-taking at the micro level, and it has these different effects on TFP. To me, the first real striking implication of the result is that monetary policy here has long-run, if not permanent effects coming through the resource allocation, even though I have a completely standard formulation of nominal rigidities. So this notion of monetary neutrality really doesn't quite hold here. And the reason is monetary policy is shifting the whole economy kind of closer to or further from the production possibility frontier because it's determining the allocation of capital across firms. The second effect I want to point out briefly is that these reallocation opportunities kind of mitigate the effectiveness of stabilization policy. So what I'm showing you here is an expression for the standard deviation of output. It depends on the standard deviation of TFP, if you want to think about that as like the natural rate of output, and it depends on the output gap parameter, mu A. Okay, so in a typical model, TFP is exogenous. If I move around mu A, I move around the volatility of output kind of one for one. But here, because TFP itself depends on mu A and goes in the opposite direction, if I reduce mu A, meaning more countercyclical policy, it increases the volatility of TFP or the natural rate, and that undoes some of the effect of the original stabilization I was trying to do. Okay. And really what's going on is a type of Lucas critique where, we typically think about TFP as being exogenous and invariant to policy, but here it's endogenous and changes with policy, and the policymaker might want to think, if I'm targeting a particular level of volatility of the economy, I have to take into account how that's going to cause redistribution and an endogenous response, which is going to work in the opposite direction. Okay. Now we can prove that the direct effect always dominates the indirect effect, but still that mitigation of the effectiveness is there. Okay. Good. So turning to the normative implications, we take a second order approximation to the household utility function. The social welfare function we get depends on 4 terms. And just to be confusing, I'll start at the end and work backwards. The last 2 terms here, which are the volatility of inflation and the volatility of the output gap, those are exactly standard, exactly the same as in like Jordi Gali's textbook for the New Keynesian model, even up to these weights, phi pi and phi mu. What's really new here are the first 2 terms. We see the level of TFP enters the welfare function directly and the volatility of TFP. Okay. And I should be clear, actually, those terms are always there in the New Keynesian model. Again, it's just that we typically think of TFP as being exogenous and invariant to policy, so we can discard them for purposes of thinking about optimal policy. But here, of course, they're endogenous and change with policy, and the policymaker has to account for them when thinking about optimal policy. Okay. So taking some first order conditions, I can derive the optimal policy. Remember, and this came up, and this was a good point, the optimal policy is an output gap rule, and it's characterized by mu A star. Again, this is the elasticity of the output gap to exogenous shocks. Okay. And we can see it depends on 3 terms and got a negative sign in front. It depends on capital market distortions, tau lambda A, the dispersion in betas across firms, so a measure of how much heterogeneity there is, and a really complicated constant that we characterize in the paper, but I'm not going to show you now, but is positive. Depends on like all the parameters of the model, essentially. Okay. So this is a nice result. It's very clean. So let me go through some special cases and we can understand the result. If there's no capital market frictions, the only thing distorting TFP, if we go back to my definition of kappa, so imagine this is 0. The only thing distorting the allocation here is the output gap. So what does the central bank want to do? The central bank just wants to set the output gap to 0. It stabilizes the output gap. It's always equal to 0. That would also stabilize inflation, and we get a version of what's called the divine coincidence. If there's no inherent distortions in capital markets, the central bank can basically achieve the first best and go back to the flexible price economy just by stabilizing prices and the output gap. Okay, we can call that like an extension of the divine coincidence. That also makes TFP efficient. Then we're back to first best. Is that clear? Okay. If distortions are countercyclical, which I've tried to convince you they're likely going to be, and that's going to be what we find in the data, that means tau lambda A is positive and the optimal mu A star is negative. That's countercyclical policy. Okay. So what's going on there? It's saying, well, if capital market frictions are countercyclical, there's too much risk in the world. Agents are perceiving the world as being riskier than it is or than it should be, and the allocation is too conservative. The central bank can help correct that by doing more real stabilization. That's going to help incentivize agents to shift capital towards more pro-cyclical firms. That's going to help improve the allocation. Okay. So that's what's going on with the distortion. If sigma squared beta, for a given value of this distortion, for more heterogeneity or more opportunities for reallocation, the central bank wants to depart more and more from price and output gap stability and wants to correct some of these distortions to the allocation. And the intuition is, the more heterogeneous firms are, the more costly are distortions to the allocation. By the way, even if there's a distortion, tau lambda A, if there's only one type of firm, sigma squared beta is 0. Now, again, you're back to just complete output gap stability. Okay, so the key ingredients here are not only capital market distortions, but also heterogeneity. You need both. Okay, I'm not going to prove it for you here, but the central bank does not completely restore allocative efficiency in this economy. And that's because as I depart from price stability and output gap stability, mu A star 0, I'm correcting distortions to the allocation, but I'm incurring bigger and bigger costs of output gap and inflation volatility. And so my point is there's an interior solution. Okay. Oh, questions? Okay. Here I'm just showing some other things we do in the paper. We look at how heterogeneity changes the standard trade-off between the output gap and inflation with cost push shocks. We look at labor market distortions instead of capital market distortions. So think about your favorite stories of the labor wedge. We look at fiscal policy. We look at joint optimization between the fiscal and monetary authority. I'm going to skip all the details now so I can show you guys, have time for the quantitative results. Oh. Sorry, guys. Oh. All my phones. Okay. So I think the whole US is doing some emergency alert this morning, I heard, but okay. Okay. So turning to the quantitative exercise, what I'm going to do here is depart from the simple rule that I showed you and assume a monetary authority that has full commitment. Okay. I'll talk a bit more about commitment if I have time. It's going to be having commitment is crucial. Having full commitment is not. A bunch of the parameters here are standard. One thing I want to point out is I'm going to set a risk aversion of 10. That's pretty high for the macro literature. That's pretty low for the finance literature. Okay, but again, I'm thinking about the effects of risk, so I want to have reasonable degrees of risk aversion. Like we talked about, I'll allow for persistence and shock, so it'll follow an AR1. I set the wage adjustment cost to match the empirical Phillips curve, and I'm going to assume monetary policy now follows a standard Taylor rule. There's two kind of key new parameters: dispersion and betas across firms, and the properties of capital market distortions. I'm going to get this dispersion and betas across firms from an exercise really similar to what I showed you like way back in the introduction, where I'm basically going to look at the dispersion in how firm sensitivity, in the sensitivity of firm level productivity to aggregate productivity growth. Okay, so I'm going to use my production function assumptions to back out measures of firm productivity. I'm going to run time series regressions at the firm level of productivity on measures of aggregate TFP, and I'm going to look at the dispersion in the coefficients. We do a lot of different corrections. We talk about them in the paper, but as you hopefully were convinced by what I showed you in the introduction, there's a significant degree of differences in these measures of cyclicality.
Sorry, Joy, when you add persistence to the shock, do you have an extra layer of disallocation going on here, as firms should change the stock of capital and respond to shocks?
We don't, because it's so simple. We don't have adjustment costs or anything like that. So there's not going to be any more misallocation. It's just going to be the firms are able to re-choose the capital, but now there will be changes in the capital stock at the firm level from period to period, because now the firm's expected productivity is changing over time. But we don't have any additional frictions. One kind of really interesting thing that comes out of this that I wasn't going to talk about, the exogenous shock here is AR1. The endogenous TFP process is not AR1. It actually follows an ARMA process. And we prove that in the paper, and we talk a little bit about that. So I'm not going to talk about that here much more, but that was one interesting thing that we figured out. Okay, but there's not going to be any more misallocation going on. And like I mentioned, that's why the IID assumption was relatively innocuous, really because I'm allowing the firms to, from period to period, kind of frictionlessly choose their capital, only subject to the frictions inside the Euler equation that I showed you already.
So the financial friction is not going to have any effect whatsoever on the reallocation of capital in response to shocks?
Financial friction is not going to have any effect on the reallocation of capital in response to shocks. I need to think that through. I believe the answer is going to be no. Yes, that statement is correct. And again, I think it's coming. Sorry to have to flip back so much. I think it's really coming through this right-hand equation here, which says all it's going to do is affect this kappa, which is like a constant term in the capital choice. So the firm's capital choice is going to move up and down with expected productivity, which is going to move with the aggregate shock. But it's always going to be to the same degree, and this is in percent terms because this is logs, kind of too high or too low. Does it make sense? Because of this guy. But this guy is a constant through time. Only this one is time varying.
And that expression doesn't depend on the process of A.
No, that's what I'm saying. Wait. This guy depends on the process of A for sure, but it doesn't depend on realizations of A. And the reason why that's happening.
Sure. But you derive that expression for an IID A. Now it's an IR1.
Yeah,
so
but
we want to keep the same.
Yeah, but this expression, this
function
part of the, yeah, I know, I get your question. This part of the expression is still going to hold. And the reason why you can see it from here, I'm sorry to go back one more. This is a conditional covariance. This conditions on everything that's known at time t. It knows the realization of shocks, but those realization of shocks in this kind of model, and maybe some of this is coming from the linearity assumptions, these conditional covariances are not changing over time. Okay? So realizations are changing. Capital stocks will be changing with expected productivity, but because we have like a constant price of risk or constant risk adjustment, this conditional covariance is constant. So it's just a constant level shift in all the firms. For each firm, it's a constant level shift. So again, like a high beta firm, its capital choice is going to go up with when productivity is high, because it's going to expect, again, high productivity tomorrow because of the persistence, but it's going to be maybe lower than it would have been because of the risk adjustment, but that difference is always going to be constant. That makes sense? Again, I think this question came up before. If I want that guy to be time varying, and there's a lot of evidence in finance that should be time varying, we would think about things like time varying disaster risk, time varying volatility of shocks, time varying gammas as an example. All of those things would do it. And then you would have a subscript T on the kappa. Okay.
Did you also have have 10 minutes, and I also have a question. So
Okay.
following up on what you just said. So the sort of the level of misallocation here is constant over time, or is varying over time, given.
So in expectation, the level of dispersion in expected marginal products is constant. But if I go to data and I back out dispersion in marginal products of capital, that will also depend on the realization of shocks.
Okay. But okay.
Does that make sense?
Yeah.
So there's a difference here between like ex ante expected dispersion or dispersion in expected stuff and realized stuff. Because of course shocks are realized. Some firms, sometimes the firms might all be closer to where they kind of quote unquote should have been. Sometimes they might be further away. That depends on the realization of shocks. Do I have an expression for you here? Yeah, I have an expression for you here. So let me get to that right now, and I'll show it to you very clearly, actually. Okay. So I talked about how to get sigma squared betas. How do I get tau lambda A? I'm going to back out tau lambda A as follows. I'm going to do regressions of marginal products of capital directly on measures of beta. That's going to give me a measure of kappa, of the equilibrium kappa, and then I'm going to use the model equations to back out tau lambda A given the kappa that I see in the data. So let me give you an example, and this will answer the last question. In the model, realized marginal product of capital equals the expected marginal product of capital, that's beta kappa sigma squared epsilon, plus the realization of a shock. If I take a variance of the whole realized marginal product of capital, I get the variance of the expected marginal products of capital, and I get the variance of shocks. To the extent that shocks are changing over time, I'm going to get time varying dispersion in marginal products of capital. That's not quite related to the mechanism in the model. That's really more about uncertainty than about risk. And I have some other papers about that. Okay. Does that answer the last question? All right. Okay. Okay. So what am I doing here? So basically I'm saying I'm going to back out kappa from regressions of marginal products of capital on kappa, right? The coefficient on beta, I'm sorry, on betas. The coefficient from that regression is going to be something like kappa times sigma squared epsilon. This is just an approximation, but we do like the exact thing in the paper. Okay, once I know kappa is a function of tau lambda A. I'm going to invert this function and I'm going to get a tau lambda A. So I'm really getting the tau lambda A by looking at the relationship between marginal products of capital and betas. Okay. Now, I kind of mentioned there's a lot of problems in measuring betas using productivity alone. The data is kind of low frequency. We were really concerned about sampling error. We're concerned about measurement error. So we kind of developed a IV strategy where I'm going to take CAPM, like style stock market betas, and I'm going to use them as instruments for the production side betas. Okay. And the kind of assumption I'm going with there is that stock market betas, meaning firms whose stock returns are more sensitive to the aggregate market return, that should be positively related to how firms' productivity is moving with aggregate productivity, essentially.
Joe, just a quick question here. How do you measure TFP?
In the aggregate or at the firm level?
Firm level.
Oh, that's here. So I have, using the production function and the demand functions and things, it's going to be something like firm revenue minus something times its capital stock multiplied by this fancy alpha, where fancy alpha takes into account like TFPR versus TFPQ and things like labor capital productivity versus total factor productivity, etc.
Right. Yeah, I'm just thinking that the regular methods don't consider financial frictions when backing out TFP, and because your world is a world of financial frictions that could affect that estimation you're making.
Yeah, that I'm a little bit less concerned about. I mean, as soon as I assume a production function and a demand function, I can always get TFP from that. Whether the firm is constrained or not, imagine a competitive model. So there's no TFPR versus TFPQ. As long as I assume the firm's on the production function, whatever made it choose its inputs, if I see its output and inputs, I can back out a measure of TFP. That's really here coming from the assumptions on the production function and on the demand function. Okay, so I'm not super worried about that. One other thing we do mention in the paper, from these regressions of firm level TFP and aggregate TFP, if there was measurement error in the firm level TFP, because it's the firm level TF. Let me think about what I'm going to say for a minute. Because it's the left-hand side variable, I think measurement error there is less of a concern, right? We're concerned more with measurement error on the right-hand side variable because it leads to attenuation bias. If there's measurement error on the left-hand side variable, and under some conditions, it won't even affect the coefficients at all. Okay.
All right.
I kind of want to get to the results. So let me show you guys just a kind of a picture of how I'm backing out tau lambda A. I think this is kind of important. So forgetting the equations on the slide, what I'm showing on the vertical axis is like a bin scatter of firms' marginal products of capital. What I'm showing on the right, on the horizontal axis, is firms' predicted TFP betas. So this is like the first stage of the IV, where I've regressed betas backed out from the firm level production data on firm stock market beta. Okay, so you can think about again, this is like the first stage of the IV. And what we can see is this strong positive relationship between these betas and marginal products of capital. And that's kind of what's telling me something about the level of the distortion. Along with, of course, all the other parameters of the model, like everything is done jointly. Okay, perfect. Okay, so let's take a look at these baseline results. So what I'm showing in the table is welfare losses under 4 different policy scenarios. Column 1 is under a Taylor rule. We can think about that as like the baseline equilibrium conduct of policy. The second column is under the first best. So here I'm assuming that there's a social planner with access to all the instruments they would need to correct all the distortions in the economy. Okay, and I'm just using this as a benchmark to understand what the effects of heterogeneity and risk are. In the third column, I'm looking at welfare losses under optimal monetary policy. And in the fourth column, I'm looking at the welfare losses under optimal policy when the central bank ignores heterogeneity and sets optimal policy like it's living in a representative firm world. Okay. The top row of the table shows total welfare losses. The next 4 rows break it down into the 4 elements I showed you in the social welfare function: the level of TFP, the volatility of TFP, output gap volatility, inflation volatility. And the last row, I'm showing you what I mentioned is a really natural gauge for the cyclicality of policy, which is the elasticity of the nominal interest rate to TFP. So think about that as how pro-cyclical is the nominal interest rate. So looking at first at column 1, under a Taylor rule, you get pretty large welfare losses. This is 1.8% of lifetime consumption in the steady state. That's pretty big for this brand of model. But what's really striking, and I mentioned up top, is almost all of the welfare losses are coming from a depressed level of TFP. It's like orders of magnitude bigger than the welfare losses coming from the more standard channels of output gap and inflation volatility. Okay, and we thought that was a really striking result. Hopefully you guys do too. Okay. If you look at column 2, what would a social planner want to do? No, the social planner wants to set TFP almost to the first, almost as high as it can possibly get. The TFP losses here are basically 0, and the social planner does that even at the cost of increasing the volatility of TFP. So what that's telling me is that under the Taylor rule, the allocation here is inefficiently conservative. There's too much marginal product dispersion, and in fact, a TFP itself is not volatile enough. The social planner wants higher level of TFP and wants more volatile TFP. Of course, under the first best, the social planner gets rid of output gap and inflation volatility, so the losses there are 0. Okay. So what does optimal monetary policy do? Optimal monetary policy relative to the Taylor rule sets a much more pro-cyclical nominal interest rate, so it does more stabilization. It encourages firms to take on more risk, and the level of TFP goes up by as much as like almost half a percentage point, which we thought was pretty significant. And so the welfare losses from the level of TFP are lower under optimal policy than under the Taylor rule. Of course, in total, optimal policy gets you somewhere towards the first best, but not nearly to the first best. And I'll show you, hopefully I'll have a minute to talk about the endogenous distortions that came up. With endogenous distortions, optimal policy can actually get really close to the first best. Okay, and the last thing I want to say on this slide is if the central bank sets policy to the optimum, ignoring heterogeneity, we know what the right thing to do then is, right? It's just to completely stabilize the output gap and inflation. So welfare losses from those 2 terms are 0. But then the central bank loses almost all the gains it could have gotten in terms of the allocation and level of TFP, and it kind of loses quite a bit of the welfare gains it could have gotten by accounting for heterogeneity. In other words, the losses from ignoring heterogeneity are basically something like 1.4% minus something like 1.1%.
We probably have like 2 minutes left.
2 minutes. That's fine. That's my main result in the quantitative work. So let me skip this slide and let me talk for a minute about endogenous distortion, since I think that's an important question. So here we're asking the question of what if the distortion is endogenous to policy? And we model that as saying this derivative of the elasticity of the distortion to shock can itself depend on the output gap behavior. Okay. And what I mentioned to you before is that under the condition that more counter-cyclical policy, so smaller mu A, also reduces the cyclicality of the distortion so that this derivative is positive, all the effects I showed you before are going to be even stronger. They're all amplified. That's because when the central bank does more counter-cyclical policy, the effects on the price of risk are going to be bigger, and the negative effects on the positive effects, on the level of TFP psi bar and the level of TFP psi A are also all going to be bigger. And we can also prove that as long as that derivative is positive, for a given level of the distortion, optimal policy is going to be even more countercyclical than what I showed you with the exogenous distortion. So let me give a quick example. So here I'm going back to my model of banking. I kind of gave you the broad outline before. The distortion depends on the adjustment cost and dividends and the dynamics of the cash flows of the banking sector. Here I'm showing you an expression for the distortion. So it depends on the adjustment cost and dividends. And in general equilibrium, it turns out that intermediary cash flows are like a leveraged claim on aggregate output. And because aggregate output depends on monetary policy, the distortion itself is going to depend on monetary policy. And we can prove in this model that this derivative is going to be positive. In other words, when monetary policy is doing more stabilization, it's stabilizing cash flows of the banking sector. So the marginal value of those cash flows are not moving around that much, and the whole distortion is becoming less countercyclical. Okay.
Joe?
Yeah.
Is that result depending on assuming in Gerle-Karadi that the collateral constraint is always binding? Because I was thinking that in a model, like a very simple model, like Kiyotaki model, the derivative maybe is not always positive. It depends on whether monetary policy is contractionary or expansionary. And yeah, that could change things.
Yeah, but here this is saying we don't know if monetary policy is contractionary or expansionary. I'm saying as I move around the expansionariness, if that's the word, and contractionariness of monetary policy, how does that affect the distortion? Here, this doesn't really depend on the collateral constraint at all. I could actually have done this just with the dividend adjustment cost. So this term phi L is capturing the collateral constraint. Yes, it's always binding, at least in the neighborhood of the steady state. But even if I had no constraint on debt, only the dividend adjustment cost qualitatively would matter here. What leverage is doing for us here is it's making the effects more empirically reasonable. Otherwise, things are not big enough in this model. Okay. Yeah. All right. So I have like 1 minute left, I think. So let me just tell you what we do. So basically what matters here, the only new parameters of this compared to the model I showed you already is the adjustment cost and the degree of leverage. And this is really in the steady state, actually, because this is an approximation. And what I'm going to do is and all that matters is the combination of these two parameters. I'm going to calibrate them so that in equilibrium, the value of tau lambda A is exactly the same as what I showed you before. And that's still valid because what I showed you before was backed out from the firm level data and does not depend at all on the micro foundation. Okay, so I'm keeping tau lambda A, the level and equilibrium constant. So the only thing that's going to change with endogenous distortions are going to be the counterfactuals. It's going to, in the counterfactual world, the value of tau lambda A is going to change with policy, whereas that didn't happen before. Okay, so I'm showing you exactly the same table I showed you before. I know I have like 1 minute left. This is my last slide. Columns 1 and 2 are completely unchanged from what I showed you before. And that's because, of course, the first best doesn't change. And I calibrated the parameters of the banking model to get the same value of tau lambda A as before. So the world under a Taylor rule looks the same. What's going to be different is the policy counterfactuals. Looking at column 3, this is optimum monetary policy accounting for heterogeneity and the effect of policy on the distortion. you get the gains that we get are much larger than we got under an exogenous distortion. And in fact, optimal policy now comes pretty close to the first best. And again, that's almost predominantly coming from correcting distortions to the allocation, and that's showing up through the level of TFP. Okay, and what I showed you with the exogenous distortion, the level of TFP was higher by about like 0.4% under optimal policy. Now that's like 1.3%. So the effects go up by a factor of like 3. Okay. In column 4, I'm showing you optimal policy ignoring heterogeneity. And now that's much more costly than it was under the exogenous distortion. And that's because, don't forget, in this setup, the distortion's only affecting the allocation. And so what's happening here is the central bank loses all the gains it could have gotten by correcting the allocation and the level of aggregate productivity. In fact, TFP is lower when the central bank sets optimal policy ignoring heterogeneity than under the Taylor rule. And in total, looking at column 4 versus column 3, welfare losses are like 1.3% higher when the central bank does not account for heterogeneity. And that's a pretty big number. Whereas that number was only 0.25% with an exogenous distortion. Okay, and so what I hope to convince you with the example is you could come up with stories, and like I said, we tried to come up with stories where this derivative was negative. We struggled. It sounds like you might have somebody there, might have one in mind, so I'm happy to hear that, and I'm happy to study it further. But as long as you're willing to think that that derivative is likely positive, all the effects I showed you in the exogenous distortion case are just going to be amplified in the endogenous distortion case. Okay, so I know I'm out of time. I'll let you guys read the conclusion slide, and I'm happy to stop there. And thanks very much.
So thanks a lot, Joel. I think we're out of time, so we can end the seminar now. And if anybody wants to stay, you can stay in the chat after the seminar.
Sure, I'm happy to chat for a few minutes and answer any questions or hear your guys' thoughts for sure.